This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. It's my pleasure to have back with me this morning Charles Hugh Smith, well-known and prolific writer on the web, who is the publisher of the website Of Two Minds. Good morning, Charles.
Good morning, Gordon. Glad to be here. I think year number 4 of our conversations.
Number 4?
3 or 4 years we've been doing
this. I was going to say we're up to getting close to 4 years, and how quickly it goes by. Charles, you just got back from a camping trip, did you not?
Yes, to Lassen National Park and Humboldt State Park here in California. So it was great to get away. No mobile phone coverage, no Wi-Fi.
and then you come back to the shock of what's going on. So you're ready to do it. Charles, I need to mention to our listeners before we begin, this is not an interview. If you're looking for an interview, cease and turn it off, because this is a dialogue that Charles and I have on a monthly basis. We pick a topic that's on our desk, and then we talk about it and we debate it. Sometimes Charles leads, sometimes I lead. And I got to warn you, probably I'm going to lead today because I brought most of the charts on and they're going to be on technical analysis. So just as a precursor here, Charles, any comments on that?
I'm looking forward to it, Gordon.
Well, so what I have up, Charles, is kind of the format that I thought we would go through, and that is the macro considerations that are going on right now that front end what these technical charts that I'd like to show. And you brought a number of those considerations, and I have a few of them from a macro perspective. But then just 3 of the reasons why things are now really getting ugly, and they're going to get uglier. Then what to expect from the central banks and the governments, because they're not finished. No matter what, I didn't say they're doing the right things, but they're not finished with the kind of manipulation that's been going on here for quite a number of years. And then I'd like to talk about something called what I refer to as the M-top, because it really positions the kinds of things that you should be looking for. Whether it happens or not, time will tell, but at least it'll give you some signposts that you should be looking at. Charles, I have up now the 8 points that we kind of debated as macro. Do you want to highlight any of them that are part of the primary risk that we see right now in the market?
Well, Gordon, I wanted to provide some context for your technical analysis. And my basic idea here was just to remind listeners who are familiar with all the guests you've had over the years. We all know that this is not a situation where, the stock market is having a normal little hiccup and it's a buy the dip, just a normal minor thing. What we're seeing here is systemic risks in the global economy kind of rearing up finally, after 6 years of financial repression. And so that's the context. We're not just talking about a minor little dip here in an ongoing bull market. We're talking about huge systemic risks which are finally becoming visible to everybody that's engaged in this economy. So that includes like just obvious stuff. Like there's too much debt globally. There's too much leverage. Malinvestment. We've got 60 million empty apartments in China. We've got corporations here, borrowing $600 billion not to invest in training employees to be more productive or new plant. No, it's just to buy back stocks and enrich the top managers. We've got stagnant income, stagnant revenues, stagnant profits, rise of high-frequency trading, which destabilizes the system and creates the risk of flash crashes. We've got a rising U.S. dollar that's causing capital to flee China and the emerging markets, which is shredding the commodity markets and all the economies that depend on that. We've got opaque banking throughout the world, dark pools of capital. Nobody knows the size or where they're throwing the money. Shadow banking in China that nobody knows what leverage and debt there is there. And deteriorating collateral, which you and I have often talked about. And one of my favorite examples is, and I'm not picking on China per se, we've got a million examples here in the U.S. and Europe and Japan too. But how much are those? How much are any of those 60 million empty flats which were purchased as investments? What's their real market value? How many of those can be sold for the price that they were purchased at? Who's going to buy it? So, anyways, those are just highlights of the many dozens of systemic risks. But that's the context. I just want to make it clear here that we're talking about issues far beyond a minor correction or a dip in profits, or the kinds of things that occur in a real organic bull market.
Thank God you went away on your camping trip to get away from this. That's a pretty depressing list, but it's that and everyone I agree with, and actually more, Charles. So the real question is, how has it managed to go on this long without even minor corrections in the market, without things coming apart? And it really is in a way an offhanded compliment to the central bankers and the government for the kinds of things that they've been doing behind the scenes, called manipulating. But what really they've put it off, but it just gets worse. These problems just build and build. Instead of cleansing it at a lower level, we now have to cleanse at an artificially too high level, and that's the seriousness of the problem. And it's just, the point is, it's just long overdue. I have a chart
here called the boundary conditions. And one of the things we've been tracking very closely since 2008, when we had the financial crisis, is how it was contained with volatility and price movements within certain standard deviations. And one of the things we found was that the 200-week moving average shown here and the 400-day moving average were very critical with standard deviations from there. And all of the movements have contained it in not only in 2008, but even right up till recently. And you'll notice on this chart that we banged off it in at least the most recent set of volatile kinds of actions. And it found temporarily support at that level, but we made some very serious damage to the technicals. And there are certain bands, as I said, that said even with some more damage, they should be contained. And I'll show that as we just kind of go along. But the question is, these things, can they be contained, or does things get out of control very rapidly? Because that's always the issue. Contagion, credit starts to move. You got too many people that are over leveraged, and it's very, very difficult once that starts to stop it. And that's what the central banks are worried about right now. They're terribly worried, and you can expect them to be in fairly quickly. They were already in when we hit the bottom of this band. You could see the action. They were in buying to shore it up. The callers were in place, but the real damage hasn't yet been done. But why is it going to get uglier from here? And there are so many reasons, but I just pick three triggers that I see that are really at play right now, that people just are not paying enough attention to, that's going to make an already bad situation even worse. And the one is, Charles, I don't think people understand, we're already in a revenue recession. Forget an economic recession that we could see. But revenues for the last 2 quarters have been falling in a negative way. If your corporations are not growing your top line, it's only a matter of time before profits and everything else start to hit. And this chart shows it's not just energy; it's the S&P and many of the key sectors, and it's now flowing right into earnings. And I could argue the last 2 earnings quarters have been down too, but I'll give you the benefit the last one might have been just barely positive. But on earnings per share, where you buy it back, things look pretty good if you buy back enough shares with enough debt, right? So right. It's just camouflage a problem that's deteriorating very quickly. And the smart money's seen this, and the smart money's been exiting for quite some time, knowing there needs to be an adjustment in that. Any comments on that part of it, Charles?
Just a quick example, Gordon. I was shocked at McDonald's, which has expanded for 40 years, has been closing stores now. That their sales are soft or stagnant or declining. and same store sales, whatever measure you want to follow. So there's an example for you that we're all familiar with. Instead of opening 123 stores, they're closing stores.
In actual fact, what they're doing, Charles, is they're actually moving to REITs, a real estate investment trust, where they're really going to be in the real estate business and move out the stores, because most of them are owned by the franchisees who own the problem. and so there's a whole spin-off that has actually been holding up the stocks, in my opinion. But you're right, the earnings have been dismal. Well, actually, you're seeing it all across all retail, not just the fast food side of it. But if earnings and revenues are falling, how can the markets and the equity markets hold up much longer? And the next chart I have, and I thought this was really telling in that regard, is this is looking at the 15 largest developed markets in the world. They're countries where we look at both the bonds and the stock markets all together in a valuation index. And this was done by Deutsche Bank, and it says we have never seen global markets this overpriced ever before. So when you get to this, you always look at it as a country, as a stocks or bonds, but when you look at this aggregate perspective, minimally it says it needs some kind of adjustment to find a platform of support. And with earnings and revenue down, something needs to give here. And even if you believe markets are going higher, it needs an adjustment. And when you're at this level, that can be a fairly violent and vicious adjustment. Second point, Charles, is the markets work in cycles. There's all sorts of cycles, and it's tough to know which one is the dominant one at any given time. Right now, there's a Shemitah cycle, which is right as we talk is coming due, and that is a 7-year cycle. It ties into sentiment shifts, and then 7 times 7 for 49 when we get kind of the old jubilees. These are long-term kinds of cycles. They play in, and you see things happening. But one of them that I have that we've been following very closely is what we refer to as the Fibonacci time extension cycles, and you see it up here on the right. And this is going back all the way to the 2008 crisis when we established this cycle and these projections. And you can see we're right now at this period of time, September, October, that we predicted back in 2007, 2008, as when we saw a fairly significant consolidation happening. And it's arriving. Well, actually, it arrived about 2 weeks earlier than our original charts, but it's happening right on time, and that's to be expected. Things go in waves; they go in cycles. It's part of the human nature, and part of next one I have up, a third one is, and I remember Alan Greenspan, when he was chairman of the Federal Reserve, and he used to do the Humphrey Hawkins before Congress. He always used to say, if he could only predict sentiment and confidence, and when it shifts, and it does shift for reasons that he never understood, he says it takes the economy with it. So when people move from euphoria to fear to greed, it happens. And predicting it is difficult, but there are cycles that it is fairly predictable. And what I'm worried about right now, and what I see in this chart here on the right, is globally, it's turned. The global sentiment, and when you look at Nielsen's, any of them, it has clearly rolled over and is beginning to fall. And the little box below in this chart is actually the U.S., and the U.S. sentiment and consumer confidence numbers, or rather confidence numbers, have been steadily falling and fairly significantly last 60 or 90 days. So when confidence starts to wane, everything else starts to follow with it. So just those three alone are suggesting that we're due. We're due for some kind of adjustment. Comment on any of that, Charles?
Only that you add the three together and the overvaluation chart, and it's extremely persuasive to anybody with an open mind.
It says it's not the time to be aggressive, the time to be cautious. This is the time you want to stand back and kind of let things settle. This chart I have up now is another way we've looked at it, and we ran regression analysis for a long period of time, going back to August 1971 when we came off the gold back and we went to a fiat currency. And we have found that those regressions centered from that period of time have been very telling and have marked, because it's really what the real store of value is in the money and what the market is willing to pay and price in, and the difference between price and value. And this is the grids that with these regressions that we've had for some time, and we felt there was going to be a sell-off here, and I'll get in a little bit more detail, that would drop down, and then whether we went up from there. But we were looking at it in a technical analysis of something referred to as an expanded flat before this whole cycle called a megaphone top could actually finish, and it's been working pretty well. Now, if we move to the next chart, what I have here is something that marks all of that cycle in more detail. And this drop that's over here on the right that we've been anticipating was something we refer to as real deflation. We have inflation, but we also have deflation in asset values. And we felt that that was going to be a big shock to the market. And we've actually had it for about 2 years, Charles, in terms of the commodities. Commodities are being absolutely killed, have taken many of the emerging markets with them who are dependent on the commodities, but it hasn't showed up in the U.S. equity index until just now it's beginning to happen. And that's because the global slowdown is so significant that we're now seeing it. So we've had this beginnings of a correction that's coming down, and you can see it going down towards those regression numbers that I showed you before, where we anticipated. And that's approximately that little red circle of where we're at in that cycle and how quickly that happened. And what's going to happen, Charles, next is that this is actually that chart I showed you in real time, this next chart, and we think it'll probably go down to that red line somewhere in there in a spike. But at that point, as I said with that M top, just showing it again, we think at that point the central government, central banks and the government cannot allow it to go any further, because the collapse in collateral values will absolutely will be devastating. We believe somewhere in here, we felt maybe around 12% correction. They will be forced to come in and do one of or three different things. They're going to have to come in with some form of quantitative easing 4, where they increase the balance sheet. They will not call it that. They'll call it Operation Twist or something else, but they will do an element of it. That's not enough any longer. That won't even begin to really solve the problem, but you can expect that. Secondly, what they're probably going to do is you're going to see finally helicopter money happen. And helicopter money means forget the banks. This is the government printing money and passing it directly to the citizens to spend under any kind of camouflage of rationale of why you should get the money and somebody else didn't. Likely forgiveness of student loans and suddenly pump $500 billion into the economy because we're going to educate, or cars, because of the automotive industry now with the leases is in significant issues, and that's a whole discussion in itself, because both of these rock the shadow banking system, who are based on asset-backed securities, which brought us down in 2008. At that point, it was mortgage-backed securities. Today, it's going to be asset-backed car loans. It's going to be student loans. And other kinds of highly leveraged loans, collateralized loan obligations that are in the shadow banking system. That's helicopter money. And then the third is just guaranteeing collateral, guaranteeing ETFs, guaranteeing funds, making guarantees that we've never seen before. And when they do that, Charles, that's why we think that'll create one more lift on the far right here that may give us a new high. It may be just a double top. It may not even make it quite that high. It'll be short-lived, maybe 6 months, maybe 10 months, maybe a little longer. And then after that, we're out of bullets. Nobody's going to believe it anymore. And then we have a serious currency crisis. So that's the kind of thing. And we've had these charts for a long time. And they're just tracking right along. And when we wrote the paper, Globalization Trap, we laid out the echo boom with the carry trade that was going to the emerging markets that would drive this. So this is not speculation. A little long-winded, but Charles, it's making sense to you?
Absolutely. And I'll just make a few quick comments. If people think all this is outlandish, we have to recall there was a helicopter drop of money back in 2008. everybody that paid federal tax got a $300 rebate. So that's an example. In other words, the government gives us all money under the guise of a tax rebate. That's one example. So, of course, that $300 did not save the economy. But I totally agree. That's the way they're going to have to try that. In terms of collateral,
Charles, they have to, because the banks won't lend. And the reason the banks won't lend is they can't find any collateral that isn't already pledged. And they're not lending money unless they know they're going to get it back.
That's right.
There's no collateral out there called rehypothecation that hasn't been pledged 50 times over, and by the way, is exposed.
Yeah, I was going to mention, Gordon, that you have a chart showing that $9 trillion has evaporated just in this little downturn.
Exactly. $9 trillion.
And that's an evaporation of collateral.
It precisely correct. That is money that has been pledged or assets. So when let's say you have a margin call here, you borrowed money against your assets to buy stocks. The stocks go down, you've got to add any more assets. So they went down before they corrected $9 trillion. $4 trillion in China, $4 trillion in the emerging markets or developed markets, and $1 trillion in the emerging markets. Now maybe it's running around $4 to $5 trillion right now. Hello, that's a lot of margin calls. And then you got to remember that you got the OPEC and major oil exporters that are trying to operate at below $40 a barrel and need much more. And they were the ones pumping money into the economy in terms of liquidity that now need the money to finance their governments and their current accounts. So they're not only not putting it in, they're actually taking it out. And then you've got China, for example, that's selling U.S. treasuries right now. That's a problem. You got Japan that's not buying as many, and you got Russia selling them. So these are all drains on liquidity.
You know, Gordon, I also wanted to mention that you've been tracking your M-top chart for a number of years, and I recall distinctly looking at it about a year ago when there was a downturn in September, October, and you called for further highs, and you were absolutely right on target. So I just wanted to tell people this chart has proven prescient.
It has. Amazing. Timing-wise, the degree of fall on it, it doesn't mean it's going to sustain itself. But what it does say is, I don't think this market's quite finished yet. And so we will find some kind of hard bottom. There's some more fear here. And then it'll depend on what these programs at the central banks come out. How coordinated are they? If something breaks in the middle of it, all bets are off, because they may not be able to fix it, even with the things that I'm preparing for. They'll have to do it earlier. And that's one of the reasons that they brought Stanley Fischer in as the co-chair of the Federal Reserve. He was a former bank central banker from Israel. And they brought him in, and he's in charge of stabilizing the markets. Now, why would they bring a man of his stature in to do this? They know, they've got the same charts that we're looking at here. They know this is the significance of a global slowdown. And they're going to crack the markets. So I believe that they're very aggressively preparing, which they've done with close to $300 billion in reverse repos, so that they have the firepower to try and stop this. Whether they stop it, whether we get another lift, we will debate. But don't think for a moment that they're about to roll over and this market's going to sustain itself going south. I don't believe that.
Right, Gordon. And, I get email from readers, I'm sure you do too, and recently some said, nope, you're all wet. It was just a high-frequency trading flash crash. And what we're talking about is, you can have those, but what we're talking about is something different. And I think that what we're trying to do is describe how there's not that many bullets left in the central bank bazookas, if you will, assuming they have multi-round bazookas.
But there's a few more, but whether they shoot them correctly, whether they wait too long, whether they can be coordinated with, because this is more than a country now. This is a global issue. And the last time in 2008, it was how the United States Federal Reserve reacted. This time it's going to be how Bank of England, Bank of Japan, ECB, Fed all react together. Are they that coordinated? Can they move that quickly? can they agree on these kinds of things? That's going to be the question, because when it breaks, and it is breaking right now, because the issue is in the credit markets. Go and look at I didn't put up any charts here today, but if you looked at the credit markets, you can see it on the spreads. They were a precursor to the 2008, and we see the same things, and they see that, and that's what they're worrying about here. So it's getting ugly. Be worried, be defensive, but the world isn't coming to an end quite yet.
That's a good summary, Gordon. And as a parting comment, I just want to remind everybody, and we've talked about it in previous shows, the central banks aren't just saving the wealthy people who own most of the stocks and bonds. They're trying to save the pension funds, and we've talked about this at length. That the whole system is dependent now, unfortunately, on a very high valuation in stocks and bonds.
If President Obama, you got 75 million baby boomers retiring. You got $10 trillion out there that's unfunded liabilities associated with pensions, and you're going to let the market and these equities drop or assets drop down. What are you going to do with the entire entitlement system? It's totally destroyed. I mean, it doesn't mean that it isn't coming to some serious crisis, but you're going to do everything in your power at this point to try and stop it. And so you just got to debate what's open, what's available to them. And until they've shot those bullets, we're not finished.
I think you're absolutely right, and I think the case that you've presented in the charts should be sobering to anybody who thinks the bull market can run another 6 years. 6
months, 12 months, strong probability of that, but it's going to be very dangerous 6 months or 12 months, and it's going to be a very artificial market. And maybe now's the time that people should be looking at other investments than the traditional stock and bond markets.
Well, I always say, along with a lot of other people, cash is a legitimate position.
Now we have a war on cash, but that's another discussion that we're going on. Charles, we're long past our hard line, and I apologize to all our listeners for doing all the talking here with these charts, but we wanted to just take one show and kind of put some perspective in from some of the technical analysis. And so with that apology to everybody, I'll wish you all the best for the rest of the month, and we'll talk to you next month. Oh, Charles, how can they find out more about your writings?
Visit me at of2minds.com.
Talk to you next month.
Thank you very much, Gordon.
Goodbye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.